The Boulevard of Broken Dreams. With China's leader Xi's absolute control of the Politburo in China secured, expect further China zero COVID lockdowns. Whether it's to truly protect citizens from COVID or to control the masses, the end result is a very bleak picture of economic growth. Until it ends. Our forecast up to this point was for the lower growth in China would directly result in lower prices for many commodities. That's happened. In addition, the further tightening of monetary policy in the US will lead to decreasing velocity of capital and lower growth. And the most recent earnings of Google, missed consensus by 15%, confirms that the recession warnings we wrote about many months ago is here and has been validated. Google lost more of its market cap on October 26th than the sum of the total market cap of all the Canadian mining companies combined in all sectors. Just think about that for a second. The amount Google lost in market cap in one day is greater than all the gold companies, copper companies, uranium companies, royalty companies, exploration companies listed on the TSX Canadian, which is the hub for mining in the world, combined. Facebook's laying off 11,000 people. Salesforce and Twitter have laid off many talented employees also. Amazon's laying off 10,000 workers in advance of their biggest money-making season of the year, Cyber Monday and then Christmas. And then there's one of the world's largest shipping companies, FedEx. They've also cut workers. When the world's largest companies make company-altering decisions like this, you want to pay attention. It is a risk-off environment. And a very unpopular thing is cash is king. Bank of America recently released a survey of over 350 fund managers, which in total manage over $1 trillion. Cash positions amongst these managers are at the highest level since the tech bubble. And remember, these guys don't get paid for holding cash. This is a sign of uber cautiousness from the big money managers. That's the chart you're looking at right now. And the cautiousness is for a good reason. Global growth is slowing, costs are going up, political instability remains high. You don't need to tell me that the equity and bond markets have been crushed this year. A traditional investment portfolio historically has a weighting of 60% equities and 40% bonds. That investment portfolio is having its worst year in 100 years. Look at the chart right there, going back to before the Great Recession. Equity markets around the world. There's just nowhere to hide if you're a generalist investor. There isn't a major stock market in the world that has generated a positive return year to date, and indices following the world's largest economies are down over 20% from previous highs. Look at the chart you're looking at right now, whether it's Hong Kong, China, the US, Europe, Japan. Everybody's had a horrible year in 2022. I still believe and have yet to find concrete evidence that either the Chinese or the European markets are healthier than the United States. However, the US is not immune either. The S&P has been in decline for nearly 200 days, losing 25% of its value in the process. So let's put that in relative terms. How long must we sing this song? Nobody has fun with the blues. So the next chart you're seeing is likely that we are not out of the woods yet, both in duration and decline. Now look at the 1929 was an awful period. It was 678 days and lost over 85%. The 2000 recession was 637 days long and just under 50%. Today, in 2022, we're at 195 days in recession and we're lost about 25%. The point being the average in the recessions is 484 days and about half. As the chart shows, typically, the S&P 500 will decline for nearly a year and suffer losses of 38%. If you look at the duration and losses during recessionary periods, the picture is much uglier. In addition, the interest rate increases by the US Fed are not finished, and I expect a few more will be coming as of this room. And it makes me strongly feel we have more pain to come in the overall markets. Now look, I'm not alone in this bearish view. Federal Reserve Chair Jerome Powell said taming inflation is going to be painful for the economy. And it is, and it will be. I don't think there's an easy way out this time. Interest rates must go up. Raising interest rates helps cool the economy by slowing the velocity of capital. There will be a time when the Fed pivots, but that ain't anytime soon, meaning in the next few months. Rate cycles writing on the wall. So This would be the first time the Fed is hiking history that rates would have risen in absolute terms this much without causing a recession. And the chart you're looking at now shows every major hiking cycle since the 1960s. And the blue is where we forecast where we are right now. Virtually every time rate hikes above 4%, a recession hits. And let's look at the dollar warpath. Swap lines activated. You haven't heard me talk about swap lines, eh? All the people that love it when I talk about positive and negative swap lines. Among all this market volatility, many people miss that Switzerland, and the ECB have begun to draw down on the US dollar swap lines. Those euro dollars. Drawing down on a US swap line means there's substantial demand for US dollars in the near term at that nation or because of an institution in that nation. In the past month, over $6 billion has been swapped, bringing the year-to-date total to $19 billion. That's the highest level outside of 2020 and since 2017. There's the chart you're looking at right now. The dollar is at its highest level since the year 2000, having appreciated over 20% against the Japanese yen and about 12 to 13% to the euro. And it's up versus nearly all emerging market currencies, except Russia. And Russia's a unique perspective. Moves of this magnitude are not typical in the currency market. This rapid strengthening of the dollar and the volatility, even in the dollar, has considerable macroeconomic implications for almost all countries, given the dominance of the dollar in the international trade and finance. The dollar's share in the world exports has held, even today, around 40%. For many countries fighting to bring down inflation, the weakening of their currencies relative to dollar has made the fight harder. On average, for every 10% increase in the dollar relative to another country's currency, inflation in that foreign country goes up by a base of 1%. Foreigners feel the heat the most. This type of situation is felt most significantly by the emerging markets because they have import dependencies usually transacted in US dollars. This creates a spiral of requiring additional domestic currency to cover international transaction and then leads to further currency depreciations. The next chart you're looking at shows the performance of foreign currencies versus the US dollar. Other than a few countries in South America and Russia, mainly the US dollar is strongly appreciated year to date. Now, Peru, Mexico, Brazil are commodity countries. This strong dollar, as alluded to above, creates considerable challenges for nations that buy and sell goods in the international marketplace. But don't get fooled with the Russia. Look at the long trend devaluation of Russia over the last decade. Approximately 50% of all cross-border loans and international debt securities are denominated in US dollars. If you think that's going to change overnight, please think that through. While emerging market governments have made progress in issuing debt in their own currency, the private corporate sectors have high levels of US dollar denominated debt. As central banks raise interest rates around the world, financial conditions tighten. It makes it harder and more expensive to borrow capital. A stronger dollar only compounds these pressures, especially for some emerging market and many low-income countries that are already at a high risk of debt distress. A strong US dollar is a trend I expect to continue for the remainder of this year. And this is a critical input into every one of my stock portfolio holdings. Stay safe in these tough times. Subscribe to the KRO, which is a Katusa Resource Opportunities, to find out exactly what prices I'm buying at and what price I sell at before the trade occurs. And you get to sell before I do. If you want to give your portfolio an edge, consider becoming a member and giving it a try for yourself.